Hello, we are still on inventory accounting. This is part 3 of IAS 2. In part 2, we saw some questions on the determination of cost of what? Inventory. In this part 3, we are also going to solve more questions, and then we will look at the subsequent measurement of what? Inventory, which are the lower of cost and net realizable value. So let's start. Let's solve more questions, and then we look at the subsequent measurement of inventory. So let's check our questions here. Okay, so in part 2, we solved questions 1. We solved this question here, question 1. We solved question 16, question 17, and then we ended, yes, so we solved questions 1, 16, and 17, which were all on the determination of cost of what? Inventory. Now, let's start with question 2. Okay, so let's start with question 2. So question 2, yeah. Okay, let me bold in this. Okay. So let me drag this one to here a bit. Okay. So let's continue. Good. Now let's look at the question. It says CN Professional Limited plans for production overhead of 200,000 per annum. So let's start highlighting the key things. Okay. Okay. So we are told that CN Limited plans for production overheads, okay, of 200,000 cedis per annum. Right, this one, 200,000 cedis per annum. The normal level of production is 100,000 units. Due to supply difficulties, the business was only able to produce 75,000 units in the current year. Other costs per unit were 126 Ghana cedis. And the requirement is, what is the cost of inventory manufactured? What's the cost of inventory manufactured? So if you watch part 1 of this standard, we said inventories are either purchased or they are manufactured. If they are purchased, then their cost will be the purchase cost. If they are manufactured, then their cost will be the conversion cost, right? So here, in this particular question, the inventory here is not what? Purchased, but it is what? Manufactured. It's not purchased by what? Manufactured. So if the inventory is manufactured, okay, then how are we going to get the cost of the inventory manufactured? How are we going to get the cost of the inventory manufactured? Right. So if you watched the first part of IAS 2, we said to get the cost of inventory manufactured, that is to get the cost of conversion. Okay, we bring all the direct costs together. We bring all the direct costs what? Together. Then we get what we call prime cost. That's direct labor, direct material, and other direct what? Expenses. We bring all together and we get what we call prime cost. Then we add a systematic allocation of what? Overheads. And we said that systematic allocation of overheads should be based on the entity's normal level of what? Production, not the actual. If you remember all this from part 1, right? Very good. Now let's continue. So here we have overhead. They plan a particular overhead of 200,000 cedis, right? So if they plan overhead of 200,000 cedis, then this overhead has to be what? Allocated, right? So we are going to have overhead allocation. Okay, so let's see our overhead allocation first. So we have something like allocation of what? Overheads. Allocation of what? overheads. Okay, I'm coming. Let me change this one to times new. Okay. So we said the allocation is based on what? The normal level of what? Production. Okay. So allocation of what? Overheads. And we said this allocation is based on the entity's normal level of what? Production. So the question is, what's their normal level of production? Okay, their normal level of production is what? 200,000. So we pick this 200,000 here, and then we divide by the number of what? Units produced. Okay, so this 200,000 here divided by, and then when it comes to the units, we have the normal level, the normal one, which is what? The 100,000. And then we have um the actual, which is 75,000. So the standard says we should use the normal level to do the allocation of what? The overheads. So if you divide this one here, 200,000 divided by 100,000, which should give you 2 cities per unit. So let me copy this city sign here. Okay, and that's what we'll be using in our what? Computation. Okay, okay, so we copy this and then we come and drop it here. Okay, so don't forget that the allocation is done, okay, using the entity's normal level of what? Production. So we have 2 cities per what? Unit. So for every unit, there will be allocation of production overhead of 2 cities per what? Unit. So now let's come and determine the cost of the inventory manufactured. So here you can even get the individual cost first, okay, and then get a total. Okay, so we can do the individual first. If you should do the individual, then other cost per unit, which we have in the question here, this 126, okay, it's likely to be the other direct cost. So other cost per unit, how much do we have? We have 126, okay. So other cost per unit, we have 126. Then we have our overhead. We add the overhead. Don't forget that this other cost per unit here is per unit. The other cost here is per what? Unit. Okay. Then we bring our overhead and also per what? Unit. Okay. So that one we have 2. So you sum it, you sum the 2, and then we have 128. Okay, that's these 2 plus the 26. So we are going to have 128 as the total. We're going to have the 128 as the total cost, and this one, it should be per what? Unit. It should be per what? Unit. Okay, because the 126 is per unit, and so we have 128. Okay, so this is the cost of inventory manufactured per unit. Now, when you get the per unit here, we can also come and work out the total. Okay, so we can also see something like if you want to work out the total, so we can see something like or. Okay, we should get a total. Say the cost of inventory manufactured, they didn't say per unit. Okay, so we have to find the total. Okay, so we can multiply this 128 cities by the unit produced. How much is produced? 75,000. So multiply 128 by 75 what? Thousand. Or equally, you can do a total. Okay, so in that case, your other cost per unit, let me broaden it and see if we get a better view. Okay, I think we are not really having So let's maintain our 10, okay, as it used to be, as it was, okay. So we put on the final answer, okay. So or then we said other costs here, other costs, okay. How much do we have? Other cost per unit is 126. Okay, so we have to multiply the 126 by, let's multiply the 126 by the unit produced, okay, by the unit produced, which is 75 what thousand, okay, and then that will give us 9,450,000. 9,450,000. So be punching along as we saw, okay, and then production overheads, production overheads. So our production overheads, okay, our overheads, overhead. Good. So our overheads here, overhead per unit is what? 2 cedis. Don't forget, 2 cedis per unit. Then we multiply it by the number of units we are producing, 75,000, and that gives us what? 150,000 if I'm right. So we'll be punching along. Okay, good. So these are the two stuff. We sum them up. Okay, and then let's sum them up, and then we'll get, after summing up, we have to get our we have to get the total cost of the inventory what produced. Okay, have to get the total cost of the inventory what produced. So summing these two should give us something like 9,600,000 if I'm right. So you can equally compute it or you can equally add it, right? So this is the total cost of inventory produced, 9,600,000, right? And equally, if you multiply the 128 by 75,000, multiply and see, you get this 9,600,000. This one, this 9,600,000, right? So you can do it that way. When you get the cost per unit. Okay, so this 128 is the cost per unit. Okay, they multiply by the 75,000, and then that'll give you 9,600,000. So the total cost of inventory produced is 9,600,000. Now, check something out. There is something what we call there is um what we call over or under absorption of overhead. In this case, or in this question, there's what we call under absorption. Okay, under absorption. So there's under absorption of what overheads. Check what the total overhead in the question: 200,000 by 200,000 per unit. That's the budgeted. Okay, or that's what they normally plan, 200,000 cities. But see, look at the one we use in the computation. Let me use my lesson to be drawing so that you see. Okay, in the computation, look at the figure we use in the computation. See, we use what? Check 150. Here it is what? 200. But in the question we use what? 150. So there's what? Under absorption. Okay, but that's what the standard says we should do. Say we should not use the actual. If we should divide the 200,000 by the 75 and use it to do the computation, this overhead would have been what? 200,000. So in other words, we would have absorbed all the overheads. But that's what the standard is saying. So we should use a normal level to do the allocation. Okay. So that's what we have what done. So watch out. And we said if you multiply this 2128 by what? 75,000 here. Remember, by 75,000 units, you also get your what? 9,600,000. 9,600,000. Okay. Okay. So that's question 2. Now let's go and look at another question, question 8. Let's go and look at question 8. Okay. So question 8 here, very nice question. Let me zoom in down so that probably you can take a screenshot. Okay. So this is starts here and then ends here. So let me zoom it down so that we can have the full question and then a shot can be taken. Okay, so this is a question. Okay, so it says calculate the cost of inventory in accordance with IAS 2 inventory from the following data relating to the Graft PLC for the year ended 31st May 2024. Right, so we have the direct cost of can opener per unit. We have direct labor cost of can opener per unit, direct expenses, production overheads, 600,000, administration overheads, selling overhead, interest expense per year. And we're told that there were 250 units of finished goods at the end of the year. This 250 is the inventory. Okay, that's the quantity produced that was not sold. Okay. Uh, so we're told that we had 250 units here, 250 units of finished goods. Okay, and then you may assume that there were no finished goods at the start of the year, so no opening inventory. The normal level of production is 750,000. So whenever you hear normal level of production, it means they want us to do somewhat allocation of overheads. Okay, but in the year ended 31st May 2024, only 450 were what produced because of labor dispute. So let's go back to this question. It says we should determine the value of what? Finished goods. So we have two requirements. So the first one is here, calculate the cost of inventory. The first one here. Okay, per unit. We have to calculate the cost of inventory. And then we have to determine the value of finished what? Goods. So let's go and solve question. So that's question A. Okay. So let me take this one up here. Let's use a new let's use fresh page. Okay. Okay. And then let me highlight all and then here. Let me see if I can get a bold something. Let me see 22. Okay. So question 8. Okay. So question 8. Very good. So let's start computing question 8. It's very, very simple. Okay. So with question 8. So let's start. So year 2, we are producing the inventory and manufacturing. So what goes into the cost? We have the first one is direct cost of can opener. So that's a direct material. Okay. So we have direct material cost of 1 CD. Okay, so let's add the Ghana CD sign up here. Okay. Always to make our workings more presentable. So Control V. Okay. So we have direct material to be what? 1 CD. Then the next one is direct labor, so 1 CD. Okay. Direct labor, also 1 CD per unit. Okay, so don't forget these ones are per unit. Then we have direct expenses also per unit. Okay, so we have direct what? Expenses also per unit of what? 1 CD. Then, so if you sum these three, you get a prime cost. Then we said we have to add allocation of what? Production overheads using the normal level of production, right? You should know that this admin expenses, selling overhead, and interest payment for the year will not be part of the cost of what? The inventory manufactured. Okay, it's excluded from the cost of inventory what? manufactured. We read that in the standard in part 1 of the video. Okay, so we have to use what? Allocation of what? Overheads. So our overheads, how much are we going to allocate for the overheads? What the total overhead in the question? Production overhead is what? 600 here, 600. So we bring this 600,000 and we divide by the normal level of production. Don't forget that. It's nice that we should use the normal level. What the normal level of what production? 750. Okay, 750,000. 750 what? Thousand. So let me close the bracket. Now, don't be confused. Let me explain this part for you. It's nothing difficult. Okay. If you look into the question, we're told that they produce what the total unit produce. They budgeted for 750. Yeah. They budgeted for what? 750, but they produce what? 450. So 450 is the total unit produced. And out of the 450, 250 was in inventory, meaning 250 was not sold. So the question is, even how much was sold? How much was sold within the year? It was 200 because they produced 450 and 250 was not sold, was held in inventory. So that's the meaning. So this figure, don't be confused. This 250, this 250 is the unit not sold at the end of the year. This 450 is the unit produced at the end of the year. Okay. So don't forget that. And that is the allocation of what? The overheads. Very good. Now let's look at the next part, which we divide this by this. So if you divide 600,000 by 750, you should get 0.8. So you should get 0.8, right? So all these ones are per unit. Okay. So let's underline here. And then what do we get? If we underline, let's underline it. And then what do we get as the total value? We are going to get 3 cedis worth 80 pesos. 3.80. So 3 cedis 80 pesos is the cost per unit of the what? Of the goods or the inventory, right? So we've gotten the first price per unit. Okay. So you can multiply this 3.80 by the 250. I think that should give you something straightforward. Okay. To get, so because this is a cost per unit. Okay. So to get the value of, so this is a cost per unit. So let me name it here. So this is a cost per unit. So this is the cost per what? Unit 366 pesos. Then the next requirement says we should determine the cost of what? The value of closing inventory. So you can do it this way, or if you want to do for all, let's say the total. Okay. So we can say something like, or if you want to do for total, what do you do? Nothing. Just multiply it. In that case, your direct material here. Okay. Your direct material here. Okay, let me shorten them. So direct material will be just multiply your 1 CD by how many units are left at the end of the year, 250, right? So let's multiply the 250,000. Okay. And then what we get as the answer? 250 and 2, 3. Then let me bring this one here small. Okay. Then the next one is what? Our direct. So our direct labor it's the same. Okay, it was 1 CD times 250. So we want to get the value of the closing inventory, the 250 units in the 250 units, which was not sold. What's the value? Okay, and then direct expenses. So direct expenses, we said it's also the same, also 1 CD by the number of closing inventory, 250,000. Okay, so we do this, and then we have we have 250 here as the we have 250 as the value of direct materials, right? So you just have to pay attention as we do the computations. Okay, now let's look at the production overheads. So we have to add the production overheads. Okay, so we have to add the production overheads. So with the production overheads, it's just like what we have done, the same thing. Okay, we have to do the allocation um using the normal level of activity. So that's the 750. So the same thing, which is the normal level of the normal level. Okay, so you can even pick the 0.8 here. You can pick the 0.8 and multiply by the 250. Are you getting it? Because overhead per unit is what 0.8. Okay, so that would be like 0.8 by the 250, or you can pick your 600,000 divided by 750 times 250. It's the same thing. Okay, so overhead per unit here, we got, so let's use the 0.8 times 250. Okay, the same thing. And that will give you 200,000 if I'm right. Be punching along. Okay, so summing all these three should give us 950. I don't know if you can also sum it. So and then let's check. So 950,000. Okay, so the 950,000 is it's the value of closing inventory. Okay, that's the value of finished goods. Don't forget. Okay, so that's the value. Let me name the value of closing inventory. Okay, value of closing inventory. Value of closing what? Inventory. Okay. So don't forget that that's the value of our closing inventory. Now, we said we can also do this. We can also do something. Okay. So let me see value. The value, let me just make it value of, then I'll use F goods. Okay. Value of F goods, meaning finished what? Goods. Okay. Or that is the value of finished goods. Okay, or value of closing inventory, because out of this 450 produced, out of these 450 units that we have what produced, um out of the 450 units that we have produced, 250 was in inventory, 250 was not sold. Okay, so this is the value, this figure here is the value of finished goods, this one here. Okay, now you can also do it this way. So we said this is a cost per unit, don't forget. The question says we should first of all determine the cost of inventory. Okay, this is the cost per unit of the inventory. And then this 950 is the value of finished goods, the 950. Now, we can also solve the 950 this way. We can also say, or let me add, or we can bring the cost per unit. What's the cost per unit? Okay, we got 3 CDs. 80 pesos. Then you multiply it by how many units in inventory? 250, right? And this will give you the same, it should give you the same 950 what? Thousand. Are you following? It should give you the same 950 what? Thousand. That's 3 cities 80 pesos by 250. Should also give us 950,000, right? Or better still, so this is also still the value of closing inventory. Or there's also another way. Check that one. Or we'll do this. So let me bring my or down. And listen, check what we're doing. How many units were produced? How many units were produced? 450 units, right? So total cost will be like total cost of all the units produced, right? We said 450 units were produced. 450 units were produced. 450,000 units. And then the cost per unit is 3.8, right? So if you multiply this, we want to get the total unit produced before we deduct the unit sold. Okay, so you get 1,710. This. So you could see this thing here. This is the total cost of the 450 unit that was what produced. Then I said we sold, don't forget, we sold what? We sold 200 units, because if you produce 450 and then 250 was left at the end of the year, then it means we have sold 200. So let's pick the cost of that, the quantity we sold. So we sold 200,000 cedis. Okay, then times the cost per unit 3.80, right? You multiply this, what are we going to get? We are going to get 760,000. Okay, we're going to say we're going to get 760,000. And we are going to deduct, because that's the cost of what we have sold. So if you deduct the 760,000 from the 1,710,000, you also come and get your 950 closing inventory. Are you following? So we have so many ways of working this thing, if you really understand the concept. Okay, and there's also another way of doing it. In that case, here, when you get to this place, this stuff here, you just use the one by multiply by the total, the 750. Okay, then we are done. You come and less the 200, the cost of the 200 cedis that was produced. I'm sorry, that was sold. Okay, so this is how we get the value of the finished goods, the value of the closing what? Inventory. So we first of all got the cost per unit, which is 3 cedis 80 pesos. And then you can come here straight and come and multiply it here. That's what we did by the 250. So maybe we can even stop here. When you get the 3 cedis 80 pesos, come and multiply it by the 250 in inventory held, and you get the value of what? The inventory, right? So this is the end of part 3 of IAS 2, right? So that's how we solve this question, the graphs PLC. Good. Now in part 4, we are going to look at the subsequent measurement of what? Inventory, which will be at the lower of cost and NRV. And then we also look at still our cost formulas still to come, our FIFO, and then the weighted average. Some say FIFO. It's also yet to come. And then so we look at the cost formulas and then the cost techniques in part 4. So please, if you like the video, please give me a thumbs up, subscribe, share with your friends, and then turn on the notification. If you also want me to improve in some areas, if you want me to do better, maybe in terms of the content, everything, please, you are welcome to make your suggestions. Okay, so I'll see you in part 4 of IAS 2.